When markets are, shaky and the whole biotech world feels like a bit of a gamble, there's this one name that just always seems to offer, well, a feeling of safety. Predictability. People call it boring sometimes, but as we're going to find out today, boring can actually be incredibly powerful. Welcome to the Deep Dive. Today we're digging into the Q2 2025 earnings from Johnson & Johnson, J&J. Our main source for this is a really thorough article, Johnson & Johnson Q2 Earnings Review. This is as safe as pharma investing gets. It gives a great look at how they're doing and where they're headed. So our mission really is to unpack what makes J&J this kind of fortress of financial resilience. We want to get into their recent wins, figure out why Wall Street's actually pretty upbeat about this seemingly predictable giant. Basically give you a shortcut to understanding a company that's, well, a real cornerstone in healthcare. Okay, so let's get into these Q2 results. J&J reported revenue, $23.74 billion.
That's right. And that was up 5.8% compared to last year, which, easily beat what analysts were expecting. They were thinking closer to $22.8 billion.
Right. A pretty solid beat. And the earnings...
The adjusted earnings per share, came in at $2.77. That was about 9 cents better than forecasts.
Okay, so beating expectations. But I guess the question is, for a company that's been around since, forever, what's the real story behind numbers like these? Is it just another quarter, or is there something more?
Well, I think what's really compelling here isn't just the beat itself. It's the beat plus the fact they raised their guidance for the whole year. That's often more important, In a market that loves hype, J&J's steady, predictable performance, and then saying, actually, we think we'll do even better. That really stands out.
Raised guidance. How much better are we talking?
So they bumped up their adjusted EPS forecast to between $10.80 and $10.90. The middle point there is what, $10.85? That's up from $10.65 before.
Okay, decent bump.
And full year sales, they raised that outlook too, now expecting $93.2 to $93.6 billion. That's roughly a $2 billion upgrade from their previous estimate.
Wow. Okay, so like the source said, when a company this old raises guidance and beats earnings and grows across the board, you don't yawn, you take notes.
Exactly. It's that predictability combined with the upward revision that's so noteworthy, especially now. It really highlights their unique position.
So where's this strength coming from? J&J is massive. Is it one area pulling the weight, or is it more broad-based?
It's really coming from their two main engines now, especially after they spun off Kenvue, their consumer health business. You've got innovative medicines, that's the pharma side, and MedTech, which is medical devices. And honestly, both are doing pretty well.
Okay, let's break that down. Innovative medicines first.
Right. So Q2 revenue there was $15.2 billion, up 4.9% year over year, and some real winners driving that. Darzalex, which treats multiple myeloma, that was up 23%. Huge numbers, nearly $3.5 billion just in the quarter.
Wow.
And Carvykti, their CAR-T therapy, that's the really cutting-edge stuff where they re-engineer immune cells. Its sales doubled compared to last year, hit $439 million.
Doubled. Impressive.
Yeah. And other drugs like Erliata and Rybrevant Lescluze, they also grew around 24%. So strong growth across several key products.
But was there a bit of a headache in pharma too? Stelara, I remember reading that took a big hit.
All right, yeah, that's the other side of the coin. Stelara sales dropped a whopping 43%.
43%. Why such a huge drop?
Biosimilars. Basically, generic competition now that its patents are expiring. It's a predictable challenge in pharma, the so-called patent cliff.
Okay, so how does a company just absorb a 43% drop in a major drug like that? Doesn't that, crater the whole division?
Well, that's where J&J's strategy really shines. They could comfortably absorb that hit because the other drugs, especially in oncology and immunology, grew so strongly. It shows the power of having a whole franchise, A diverse portfolio. They're not just relying on one blockbuster. It's not a one-trick pony situation. They've built resilience into the model.
Makes sense. Diversification in action. Yeah. So, okay, while pharma is managing these ups and downs, what about MedTech? You said that was doing well, too. Seems like it's becoming more important.
Absolutely. MedTech is increasingly becoming this quiet juggernaut for them. Q2 revenue there jumped 7.3% year over year to $8.54 billion. It's definitely key to their defensive growth profile.
What's driving that growth in MedTech?
A few things. Cardiovascular devices were really strong, up 23%. That was led by a Biomed. They make heart pumps and also their electrophysiology tools, which are used for heart rhythm issues. Surgical vision and robotics also grew nicely, partly thanks to their new OTEA surgical system.
OTDV. That's their answer to the Da Vinci robot.
Sort of, yeah. It's their play in the robotic surgery space. And then orthopedics was a little soft, but that was mostly offset by strength in things like wound closure and trauma products. So overall, pretty solid performance.
Okay, and this is where it gets really interesting, right? The tariff thing, the source mentioned, this had a big impact.
Yeah, that was a significant piece of news this quarter. They initially expected MedTech tariffs to be a drag of about $400 million for the year.
Oh, ouch.
But they updated that, slashed it in half. Now they only expect a $200 million hit.
And the market loved that update, didn't it? Stock jumped.
It sure did. The stock jumped nearly 6% that day. Its biggest single-day gain since March, I think.
Wow. So just cutting that expected cost in half sent the stock soaring. What does that tell us?
It tells you a couple of things. One, it shows MedTech's resilience and its operational efficiency. Two, it shows how sensitive the market is to these kinds of macro factors right now, like tariffs. And three, it really highlights how important MedTech is becoming to the overall J&J story and investor sentiment. It's not just about the drugs anymore. It provides a different kind of stability.
Okay, so solid operations in both divisions. Let's talk about something else J&J is famous for, the dividend. They're a dividend king, right?
Absolutely. 62 consecutive years of increasing their dividend. It's an incredible track record.
And the current yield is around 3.2%.
Yeah, roughly 3.2%. And the payout ratio, the amount of earnings they pay out as dividends, is only around 48%.
So plenty of room to keep raising it.
Exactly. It suggests those increases are very sustainable. And this ties back to their cash flow. They generated a massive $6.2 billion in free cash flow just in Q2.
$6.2 billion in one quarter.
Elite levels of cash generation.
The source had a great line. Speculative biotech might offer huge upside, but doesn't let you sleep. J&J's dividend is practically a NyQuil for your portfolio.
That's a good way to put it. And it raises a key question, doesn't it? In today's volatile world, what does that kind of reliable cash generation and dividend offer investors?
Yeah, what does it offer? Seems like it peels across the board.
It really does. For income investors, it's obviously very attractive. For those worried about market swings, it provides a real sense of security. For retirees, it's dependable income. It's that consistency that's so valuable.
So given all this, the earnings beat, the raised guidance, the strength in both divisions, the dividend, it's not shocking Wall Street was pleased. What were the main things analysts were highlighting?
Well, you hit the main ones. Definitely the upward guidance revision was huge. The MedTech momentum, and especially that reduced tariff impact, that was big news. Also, their performance in the U.S. was very strong domestic revenue, up almost 8%. And the market always likes seeing traction in oncology, complex therapies with recurring revenue. J&J delivered there.
Anything else?
There were also some favorable currency tailwinds. Changes in foreign exchange rates actually added about $1.1 billion to their revenue guidance, so that helped too.
So basically, they deliver predictability when everything else feels uncertain.
Pretty much. In a healthcare world clouded by tariff talk, litigation worries, potential policy changes with the election year, J&J just delivered solid, predictable results and raised expectations. That's reassuring.
It really underscores that point about updating your mental firmware, doesn't it? If you still picture J&J as just baby powder and Band-Aids.
Right. You're missing the picture entirely. The Kenvue spinoff really sharpened the focus on these two high-tech areas, innovative medicines and MedTech. They're a pipeline machine now.
So what's actually in that pipeline that's exciting, beyond the drugs we already mentioned, like Darzalex and Carvykti?
Oh, there's quite a bit. Carvykti itself, they're doing trials to see if it can be used earlier in treating multiple myeloma, which could dramatically increase its potential. Then there's TAR-200, that's for bladder cancer. Phase 3 results look really promising, and it could be a blockbuster if approved. High unmet need there.
Okay.
They also have IMA-ALV, a recently approved drug for myasthenia gravis, a serious autoimmune disease. That's starting to ramp up. And Spravato, their treatment for resistant depression, is getting more regulatory support over in Europe.
So a lot happening on the pharma side. What about MedTech innovation? We mentioned Otateva.
Right, the OT-TAV robotic system. Look, it's still behind Intuitive Surgical's Da Vinci system, no doubt about that, but it's a serious long-term play for J&J. It offers synergy with their other surgical devices and tools. It's about being a major player in the future of surgery, which is increasingly automated and robotic. It shows they're investing heavily in that future.
So yeah, definitely not just Band-Aids. But we do have to address the elephant in the room, or maybe the cloud overhead. Yeah. The talc litigation.
Right. That's the big ongoing challenge. Over 60,000 lawsuits alleging links between their baby powder and cancer.
How big of a risk is this, really? They've set aside billions, right? But it keeps going. Some plaintiffs rejected a huge settlement offer recently.
Yeah, they offered, what was it, $8.9 billion, and it wasn't enough for everyone to sign on, so the legal battles continue. It's definitely a wild card, and investors need to be aware of it. It's part of the due diligence.
Could it, derail the company?
The market consensus seems to be probably not. While it's significant cost and a reputational headache, it doesn't seem like an existential threat that would fundamentally break the business model. Remember that $6.2 billion in quarterly free cash flow and the $25 billion authorized for share buybacks. This is a company built financially to withstand these kinds of shocks. It's a massive cost, yes, but likely manageable within their overall financial structure.
So it's a serious issue, but maybe not a company killer, is what the market thinks.
That seems to be the assessment, yeah. And crucially, it hasn't stopped them from investing in growth or executing their strategy. It speaks to their resilience and maybe their experience in managing these complex, long-running legal issues.
Okay, let's circle back to that cash flow. $6.2 billion in Q2. You mentioned buybacks. How else are they deploying all that capital?
They're investing heavily back into the business, particularly in manufacturing. They've committed $55 billion over 4 years to build up their U.S.-based manufacturing footprint.
$55 billion, that's huge. Kind of a reshoring effort.
Exactly. Boosting supply chain resilience, creating U.S. jobs. It's a massive long-term investment. Beyond that, their capital spending is very disciplined. They're putting money into the pipeline, getting drugs through regulatory approvals, improving operations. But they're not really known for, chasing splashy, speculative moonshot deals. It's more precise.
Virtual precision, perhaps.
Maybe. And yes, the share buybacks are ongoing, providing that quiet boost to earnings per share over time. It's the kind of steady, prudent capital allocation that conservative investors really appreciate.
And dividend lovers, too, presumably.
Absolutely. It all feeds back into that sustainable dividend growth.
Okay, so let's talk valuation. The source argued J&J isn't necessarily cheap, but it might be undervalued for what you're getting. Can you unpack that?
Sure. So if you look at its forward price-to-earnings ratio, it's around 16. Historically, J&J has traded closer to maybe 18.5 times earnings, so it's a bit below its average.
How does that compare to, say, other big pharma companies?
It's generally lower than some peers. Its EV to EBITDA multiple is around 12x, which trails companies like Merck, and it's way below the really high multiple you see on a growth darling like Eli Lilly right now.
And you get that 3.2% dividend yield on top.
Right, which is better than the 10-year Treasury bond yield currently, and better than many other blue-chip stocks.
So why the discount? What are the market's hang-ups?
It's likely a combination of factors we've touched on. The ongoing talc litigation uncertainty definitely weighs on it. Concerns about potential drug pricing reforms down the road. The upcoming revenue loss from Stelara, the patent cliff, and honestly, just its reputation for being boring or slow-growing compared to, say, pure-play biotech or tech stocks.
But the argument is that these are manageable or temporary.
That's the bull case, yeah. The litigation, while costly, seems contained. The Stelara cliff is being managed through pipeline growth. Pricing reform is always a risk, but J&J has scale and diversity. And the boring aspect, well, that's tied to the stability that many investors actually seek. So the strengths, the diversification, the cash flow, the dividend, the pipeline are seen as permanent and growing, while the overhangs might be temporary or priced in.
So the opportunity is for patient, long-term investors.
Exactly. J&J probably isn't going to double your money in a year, but the potential is there for steady, quiet compounding, maybe 7 to 10% annual returns, including the dividend for potentially decades. And you get paid that decent dividend while you wait. It's a discount for patience, perhaps.
That makes sense. Thinking about their structure now, Pharma and MedTech, how unique is that in the U.S. healthcare landscape? Who else really competes across both those big areas?
It's actually pretty unique at their scale, if you think about the other giants. Pfizer, mostly pharma now, Merck, Pharma, Medtronic, that's almost entirely MedTech.
So very few direct comparisons.
Abbott Labs is probably the closest comparison, as they have both pharma and device divisions. But even Abbott doesn't quite have the same oncology firepower or just the sheer global scale that J&J possesses.
So spinning off Kenvue really did make them a more focused but still uniquely broad healthcare player.
I think so, yeah. It made them leaner, maybe more strategically agile, but they still retain that incredible breadth across innovative drugs and advanced medical technology. It's a significant competitive moat.
Okay, so looking forward then, what are the key catalysts we should be watching over the next, say, year or two that could really drive the stock?
Well, several things we mentioned from the pipeline. If CARVY-YKTI gets approved for earlier line multiple myeloma treatment, that could significantly expand its market. That's a big one.
Mm.
FDA approval for TAR-200 in bladder cancer would be another major catalyst.
Right.
Continued expansion for Spravato in Europe. And then on the MedTech side, seeing wider adoption of the OT-TAVA robotic system. If hospitals start buying and using it more, that could start to challenge Intuitive Surgical's dominance and prove out J&J's investment.
Any other potential drivers?
Yeah.
Acquisitions?
Potentially, yeah. J&J has the cash flow and the balance sheet to do bolt-on acquisitions, buying smaller companies with promising technology or drugs. They have a history of doing that quite effectively, often stealthily, so that's always a possibility. And of course, continued successful execution of their plan to replace Stellara's revenue with newer immunology drugs like Tremfya and Simponi-Aria. Early signs suggest that's working.
And what should we specifically look for in the next earnings report, say Q3 in October?
Continued strength in U.S. sales would be key. Any signs that the Stelara decline is stabilizing or that the newer immunology drugs are ramping up faster than expected. Obviously, any further updates to the full-year guidance. And updates on those pipeline milestones progress on TAR-200 approval, the OT-Vive rollout. And unfortunately, you still have to watch for any major developments in the talc litigation, whether it's court rulings or settlement progress.
Got it. It really does seem like J&J's safety profile is about more than just the numbers, doesn't it? It's this institutional credibility.
Absolutely. Think about it. This company is a core holding in countless pension funds, retirement accounts, major ETFs. It's trusted. And look at its history. It weathered the dot-com crash, the 2008 financial crisis, the COVID market meltdown, even the opioid crisis fallout. It holds up during turmoil.
What does that say about a company when crisis management seems like just another Tuesday?
It speaks volumes about its fundamental strength, its diversification, its financial discipline, and its sheer experience. They have, as the source implied, probably more regulatory and crisis experience than many governments. It creates an unparalleled safety perception.
So how does it fit into a portfolio?
Yeah.
Seems like it could play different roles.
Definitely. For a growth-focused investor, it can be the stable ballast, the anchor that lets you take more risks elsewhere in the portfolio.
Okay.
For income investors, it's that reliable dividend check, the royalty check that never bounces, as the source put it.
Yeah.
For someone focused on retirement, it's almost like a bond, but one where the payout tends to go up every year. A bond proxy that raises its coupon.
And even for ESG investors.
Well, they're investing heavily in things like surgical innovation, using AI in healthcare, responsible U.S.-based manufacturing. So there are aspects that align there, too, despite the talc issue being a clear negative on the S&G fronts for some.
The source used an analogy. Not a rocket ship, but a nuclear-powered train.
Yeah.
Slow to start, impossible to stop, always moving forward.
That captures it pretty well, I think. Steady, powerful, reliable momentum.
So wrapping up, it feels like Johnson & Johnson isn't just, another big healthcare company. It's almost a case study in building a business designed to last and still grow, even after 140 plus years.
Yeah, the earnings power comes from that layered approach. Pharma, MedTech, the deep pipeline, the solid balance sheet, the consistent innovation balanced with stability.
I like the final analogy from the source, too. If your portfolio is a house, J&J is the foundation slab.
Right. Big, maybe boring to look at, mostly invisible.
But absolutely essential. Without it, the whole thing might crumble when things get shaky.
Exactly.
So the final thought for you, the listener. In a world obsessed with risk and quick thrills, could boring actually be the most exciting path to long-term financial security? What does J&J's resilience really tell us about what matters in the market over the long haul?